There we are, and welcome everybody to Freightonomics, the wonderful podcast/show that you get to watch us talk about the combination of freight and the macroeconomic environment, as well as explain some of its principles and the things that interact within this world. And with me, as usual, Anthony Smith, lead economist at FreightWaves here, and I'm Zach Strickland, director of Freight Market Intelligence. So we will have the wonderful, illustrious Dr. Zac Rogers on the show here in a little bit to discuss the most recent, LMI, Logistics Managers Index findings. But before we do that, Anthony Smith, what are you doing over there?
So right now, I'm on this lovely laptop here looking at LinkedIn because we are streaming live if you're watching this at 2 p.m. Eastern Standard Time on a Wednesday. And I am looking at all of those lovely comments, hot takes, anything that you may have. Please add on to the conversation. We have Mark Pena saying big shout out from South Florida. Thank you, Mark, for joining us and jumping on the conversation. Also going to be watching Facebook Live because we're streaming there as well.
Yes. Very good. So, yeah, on today's show, we're going to talk about the LMI. But up first, we're going to talk about a story that kind of, this has been one that, we didn't really get to see the full impact of some of these regulations, year over year. We had a few key things. We thought that a lot of capacity was going to come offline this year due to, slowing freight conditions coming out of, 2019. The freight market was still rather depressed, not exactly active before COVID. And then COVID, of course, sent us on this roller coaster ride that has been 2020. But the freight market, again, and the transportation sector has been one of the strongest to recover here in the last couple of months. Freight volumes sequentially rising every single month since the month of April. We're seeing volumes well above what we saw in 2018, which of course increased a lot of, inspired a lot of people to go out buy trucks, et cetera. Class 8 orders still nowhere close to that period of time just yet. But again, that is a little bit of a lagging response in a lot of people's cases. We still haven't seen a lot of that investment kick in. A lot of companies sitting on cash. But one of the big problems that we talked about on a recent episode of Freightonomics is the driver hiring issue. And the FMCSA earlier in the year put out, they started the Drug and Alcohol Clearinghouse, Anthony Smith, and they started, this process of vetting drivers a little bit more thoroughly, requiring a lot of carriers to go out and check and basically create a repository of any of the drivers or potential employees that may or may not have had, drug or alcohol offenses while operating a vehicle or otherwise. Hence, making the environment a little bit safer to operate in, making it a little bit harder for people to simply go out and buy a truck and just start operating. So most recently here, test results up 8% in September in terms of positive tests. So this is an interesting number to me. This is the first I've heard of it this year, like really. And we sit right here in the center of the freight world, right. In Freight Alley in Chattanooga, Tennessee. And so for me not to have heard about this until now, we're in what month is it? Do you even know?
Somewhere in like October. It was October 2nd, like 2 days ago. Yeah. And I think it's almost Halloween now.
So October is what, the 10th month?
Yeah. Yeah.
So we're 10 months into this, and just now is the first time that I personally, now maybe I've just had my head under a rock for a little while, but this is the first time that I've heard of this. And John Gallagher wrote this wonderful article giving a little breakdown of, the trend analysis of some of these positive tests. Now, it is interesting to note that, a lot of the, stuff really year over year, we don't have the comp for year over year just yet. But the fact is that they're actually increasing the amount of requests or inquiries into the database as we go on. So some of this is a product of simply just people requesting more. So that's why you see an increase, the concrete increase in rate, positive tests. But, the thing is that also paints a picture. The fact that they're actually trying to hire these drivers right now in more frequency means that we could be, we don't see Class 8 orders up just yet. We don't see used truck orders back anywhere close to where they were in 2018, 2019, when there was such a glut of orders. going on means that there's probably a lot of unseated trucks already out there. So, looking at OEMs and things like that as a leading indicator of capacity increases, if carriers are having trouble seating trucks, you're not going to see them order a bunch of trucks that they can't seat. So again, this may have, why this is significant, Anthony Smith, is I don't know why. No, obviously the reason is that, if capacity is not going to swell to meet demand, I don't know if you remember your Economics 101, I always have to remind you about that supply demand curve.
Yeah, it's not an equilibrium. There's going to be a shortage or something like that.
And what's that going to do to prices?
That's going to skyrocket prices when there's a shortage.
Or it's going to keep them elevated as we're seeing right now. So spot rates still high. We do expect to see some of that demand fall down. But please, this article labeled truck drivers testing positive for drugs increased 8% in September. It's a good read. It's got some good stats in it. And of course, I do like my numbers and stats.
You do. Also, John Gallagher, because he's an excellent writer. We have a lot of amazing writers here at FreightWaves. A linked article that he also has that's at the bottom of this one is, it was put out in June, which was like yesterday or something like that, but June of this year, and it says marijuana, cocaine, top drug clearinghouse violation. So it has a really cool graphic down below on that article that shows which drugs are kind of being popped for the most, and by far, of course, is, or in the graphic, marijuana, not even a close second, but like way back behind is cocaine, and then we have methamphetamines and amphetamines. So I'm only guessing that's a lot of times to
that
stay awake.
Yeah.
I can only imagine, but it's such a smaller subsector or segment compared to marijuana being so much higher.
And that's interesting too, because marijuana, this is where having states legalize in some areas and not. And I got actually a little. I'm glad you brought this up, but a little side story of my experience back in the day about asking our HR, how do we handle?
I didn't know where this was going. Your experience back in the day, I didn't know where this was going.
I was talking to our HR about how do you manage, and this is way back when Colorado and Oregon were only like two of the only states that had it legalized for recreational purposes. And they, I said, well, how do you say that you can't use this when it's legal in a state? And she said, well, it's because liability. And that's all she had to say is maybe as a federal or a state or legalizing certain drugs are okay in terms of recreational use, but as a guideline or a policy, we have to, there's problems there that we can't regulate. You can't test. Marijuana stays in your system for a long period of time, 30 days. Alcohol leaves your system in 24 hours. So effectively, there's no good way of regulating this in terms of saying that you were using this while operating a motor vehicle. And obviously, they have to lean towards the side of safety and precaution. So they just have to hold that line. Like, even if they do legalize in 15 other states, it doesn't make a lot of good business sense, especially from the safety perspective, to say that this is an okay substance to use.
Right.
So I found that really interesting, because I really wasn't thinking about it in terms of just being like, yes, safety and all that kind of stuff. I was just thinking, well, you can't stop me from doing anything. And it's like, well, yeah, they can if you're agreeing to work. They can stop you from doing a lot of stuff, inside and potentially outside the workplace, depending on your job, of course.
Definitely.
So I thought that was good.
We have an active comment section right now. Big shout out to William Rufu out here. Canada, transportation at Amazon, QCon, shouting out from Cleveland, Ohio. Timothy Dooner saying, I like the matching outfits. Jake McLeod saying we are adorable. Amanda Miller saying we're twinning. Dooner hearkening back to a Spider-Man meme where they're just pointing at each other. Andy Hendrick, hello from Oklahoma City. Debbie Strickland saying love the blue today. So we have
hey, Mom.
we have an awesome interaction right now. Keep it going, especially as we have Zac Rogers on here shortly. I'm excited to have him on.
Yeah, and I think we're about ready to have Dr. Rogers on here to discuss our latest LMI findings. But while we're getting him queued up here, Anthony Smith, anything in the macroeconomic world that we need to be aware of that you see here over the last week. I know it's been relatively flat in the freight market here over the last couple of weeks. Not a lot of volatility there, even though we're still seeing volumes up. They've kind of leveled off, fallen in a lot of markets, not necessarily dramatically by any means, but we appear to be going through some form of slowing of the market. Again, not unusual for October, right before the peak season.
Yeah, really for macroeconomic releases, we haven't had a ton just yet from this week compared to last week, but I don't know if I've mentioned this on the last show, but the ISM Services non-manufacturing index came out, and we don't talk about it too often, but one of the things that did pop out and caught my attention was the subsector for employment, and that was over 50. So now employment for the services side expanding, and so that leads to more jobs within the service sector, of course, looking at hospitality, restaurants, finance, maybe education. So these services side are increasing in employment opportunities, or employment overall growing for the first time since the pandemic. So that's going to lead to more income for more individuals, more consumption. So it's going to be a good time for consumers, hopefully. Of course, the virus is going to really dictate the path of everything, but I was happy to see that that expansion in employment within the services side, of course.
Yeah, that's good. A lot of times people kind of ignore that services aspect a little bit, not realizing that it's all connected. 70% of the economy, services related, but those people that are in those service industries purchase durable goods.
Yeah.
So we need them to have money so that they can put these orders in. And again, capital expenditures, a big part of that too. If they don't have the money to spend on it, what?
Yeah.
There's no freight to move.
Yeah. And speaking of things to spend on, I mean, one of the things I think we're going to chat about with Dr. Zac Rogers here shortly, we established that it's October 14th. Yesterday was the 13th. So yesterday was the first day of Amazon Prime Day. Today is the second day.
Yep.
This also kind of leads into other major outlets and other major retailers doing their big e-commerce holidays. Best Buy jumping in on the activity. I'm sure Target. There's going to be a host of typical brick and mortar stores jumping in on this trend. And I think this is one of the things I'm going to ask Dr. Zac Rogers is this going to be like, does he think the initial peak of all this activity coming from the consumer, or is it going to die down? They're going to see another peak during Black Friday or Cyber Monday. That's going to be very popular. So there's a lot of potential holiday season purchasing to happen right now. So there's this kind of extended the length of what would be a typical holiday season.
Yeah, and we had a maritime expert, Henry Byers, on last week, and we were looking into some of our maritime data. And we've just released a few. We're in the process of testing a few of those products right now on our Sonar platform. And one of the ones that I find really interesting is our most recent release, the top 100 consignees imports report that we built, and Henry was a big part of that, along with John Ellis. And you can see Amazon's imports, or the import volume coming into the country. And this is stuff that is cleared customs, hitting the country. They have barely slowed. They had a big surge of imports there in September. They almost have this real rhythmic import schedule that they have. Most of this coming through California, Los Angeles, Long Beach, but also Oakland and Tacoma, Washington. But then, of course, Newark, New Jersey, and Philadelphia have a lot of freight coming in their way as well. But again, I don't see the systematic slowing that we would normally expect after such a hot peak maritime season. Again, tune into that episode if you want to hear more detail about what that means and how maritime traditionally kind of flows. I myself, back in the day, didn't even think about maritime. And I was sitting in a desk pricing freight, never forecasting demand accurately whatsoever as a financial analyst in that role. But if I'd had some of this information, I certainly would have been better prepared. And again, Amazon not showing any real slowing month over month, maybe like 1% off of last month. But again, this is really indicative of what we've seen all year out of the maritime side. They're just pushing freight. And I know Amazon is going to be driving a lot of this stuff throughout the peak season here and Prime Day. God knows, if they didn't have this freight available in some of these distribution centers and warehouses, if they did not anticipate what was going to happen on Prime Day. I know that one of my favorite items was the Instapot from years past. We talked about it being like the biggest ticket item on Amazon last year. I mean, but who forecasts that?
Right.
You know, like I don't, you know, there's a lot of things that you just don't see. And that's been the story of 2020 is not knowing what are the items. And of course, yesterday was a big day too. Apple.
Yeah.
Yeah, Apple was, they announced the iPhone. Went into
iPhone, was it 12?
12.
Something like that?
The 12 and PlayStation 5, two of the biggest items. Reading reports.
Or Xbox.
Well, but those are the two monster Christmas presents.
But Xbox.
I'm not saying there's anything wrong with the Xbox, Anthony. Don't get emotional on me.
I'm getting emotional.
See, this is why I'm here, though.
I'm getting emotional. I think Dooner would agree with me. Xbox.
I'm just keeping you focused on the numbers and the facts of the situation. Those are the two items this year that are supposed to be driving a lot of this holiday season consumption. So, you know, I think every one of us is still, and once we get Dr. Rogers on here in a second, you know, he had a good statement at the end of the last time he was on. He expected, we were talking about peak season this year. What do you expect that to look like, considering that freight is already booming?
Yeah.
He basically said we would see a hump, but the majority of that hump or increase in volumes and rates would be absorbed in what is already existing.
Yeah.
So it would be masked a little bit. We wouldn't see that, you know, tender rejection rate go from 5 to 12% like we saw last year.
Yeah.
But we, you know, since the rates are already high, we might see a 25 to a 28, 29%. So it's not going to just double down on tender rejections or anything like that. And volumes, again, up 10 to 15%. Maybe they get up to 17, 18%.
Right.
So there's a hump, but it's not necessarily we're going to see this dramatic increase year over year by any means.
Yeah. And the other thing I think that Dr. Zac Rogers really brought up last time I chatted with him that was a really great point was the return rate potentially. So looking even further into the future, which is somewhat dangerous and scary and during these turbulent times here in the world. I was going to say the U.S., but the world. The returns for e-commerce bought goods compared to brick and mortar stores are, I think, 2 to 3 times higher potentially for certain goods. And so we're looking at that. That's going to present an entire host of problems potentially downstream when we're looking at what's going to happen late in 2020, early 2021 with certain returns after this holiday season.
Yeah, reverse logistics has been a huge issue in years past. Now, returns don't normally move. If you've listened to Dooner on What the Truck and various shows, he actually has a ton of experience in this environment, and I didn't realize just what they do with some of these returns. I was in the, you know, we transported a lot of floor covering goods and stuff in my experience, and this was the, you know, it's not like a huge hot item to move. There's actually a lot of delays. The logistics of returns is more about consolidation and just getting enough freight to move all at once versus, well, this freight has to be here at this point in time. Return logistics is more about, okay, we've got, you know, here's our Xboxes that got returned because everybody went and got a PS5. And then they have, you know, here's our iPhone returns and here's our...
Because everyone got an Android.
Yeah, you're right. And here's our Furbies and stuff like that. So they put all these together and then they return them at once when they have enough to move, whereas they're going to ship, you know, partial shipments at times during this time of year just to make sure it hits the shelves.
Yeah.
So they can get all that revenue. But in terms of reverse logistics, it's more about cost, savings. It's not necessarily as service dependent as that front end is. So, yeah, but at the same time, seeing as we're in this new environment of, I don't want to say new environment of e-commerce because that's wrong, but it's more of an exaggerated e-commerce world that we're going to see in 2020 because a lot of people are still at home. You know, our team is largely at home still, and that's gonna lead to a lot of these, you know, endpoints being dead ends for a lot of carriers. So they're basically going to have to, you know, warehouse space. Something that hopefully we get to talk about with Dr. Zac Rogers here soon is going to be a thing that a lot of these retailers and e-commerce providers are going to have to deal with coming up. You know, just to tease that out a little bit while we're working on Zac, you know, the LMI measures warehouse capacity. And, you know, some of the figures are pointing to warehouse capacity getting a little bit tighter. As inventory levels go up, again, another item of the logistics managers index. And then, of course, warehouse prices.
Yeah.
Subsequently increase as well. Warehouse prices were actually higher a few years back, but now they were expanding more rapidly a few years back. And again, something to note about the LMI is that it's more about a direction of the market. So is it contracting strongly? So say it was $2 a square foot to rent warehouse space in 2018, and it adjusted higher because the whole economy was going haywire at that point in time. And also warehouse space was relatively, not necessarily as big of demand as it is today. But so now it's at $4 a square foot.
Yeah.
Just to throw numbers out there. So now it's going to take a lot more to say that this warehouse capacity or warehouse prices are expanding rapidly, because they're not. They've already kind of adjusted after that 2018 period of time, 2019, when we saw a big pull forward in that space.
And I can only imagine a lot of competition, right? So looking at producers or shippers that want to be closer or more conveniently located to be in position to get to those final consumers much more quickly. You're looking at Amazon Prime, either same day or next day shipping. You're looking at Best Buy or maybe Walmart or Target, some of these cold chain that maybe want to do more of the food delivery things to get food goods to people. But looking at overall where these shippers are located and giving in where these warehouses are located are also going to be crucial, I think, for overall placement. And so I think that's going to be another hurdle or kind of price point to factor in. We're looking at this warehouse capacity crunch.
Yeah, and again, it's inventory management is going to be a real big item this year in terms of hot button, supply chain management issues. Without a solid blueprint to go off of, look what happened to the freight market this year.
Yeah.
You didn't know that there was going to be such a huge demand for Lululemon, and athleisure.
Yeah.
And so without knowing that moving forward, that created a huge amount of expedited freight movements coming across the ocean. Shippers, of course, and this is a topic that I did want to talk about at some point. We just had a Nobel Prize on auction theory handed out. At some point in the future, we should definitely do a deep dive on this topic.
Definitely.
But it's basically identifying where this is extremely applicable to today's environment, where we have a lot of people basically bidding on capacity. That's where you see shipper A needs to get freight from Dallas to Atlanta, $2 a mile. Shipper B comes in at $2.10 a mile. And so they're bidding up the price, and without understanding how much of the value is for the other person. So maybe it's worth $2.20 to shipper A. They come back in and say, okay. And so they get into this bid war, and then they start to overbid the value because they get into these bidding wars. And, something that we've seen this year is not necessarily about securing capacity, but basically having service as well. So a lot of the maritime orders, we talked about it last week, the ships were taken offline because they forecasted lower demand in the near term. And that takes a lot longer time to get that capacity back online on the water, not enough boats. This created a bit of a panic environment for the shippers out there that have said, okay, we can't rely on China to be a production outlet for us now, because we've now had 2 years in a row of sourcing issues out of China, even though they're still set up to be one of the largest producers.
Yeah.
And number two, now the boats are not available.
Yeah.
And it takes 12 to 21 days, listening to Henry Byers talk about this, coming to the United States. So if you miss out on a month placing your order, you've got to place these orders ahead of time if you want to get this into, especially coming into Christmas, retail peak. You don't have the shipments available. Basically that puts you into a state of panic.
Yeah.
And that's really what we've seen is, a lot of, I believe, in my mind, a lot of kind of shippers panic because now they've had such trouble in their supply chain with getting some of these orders into the country and producing them as well, that they're now, it's almost like an exaggerated pull forward, especially on the retail consumer end.
Yeah, and it looks like we're having some activity here, but going on with, I think, what's happening with that lead time. I mean, like you mentioned, can't really be depending on China to supply some of this um, activity that we are seeing coming through on the consumer side of things. Is what's the next solution? So everyone's been kind of leaning towards, okay, nearshoring or finding other countries. And we talked about this before in the past. Not every country is explicitly set up like China is set up, because China has made if it was a basketball player or a football player, an athlete, has made a career out of manufacturing. And there isn't a close second place for them. I mean, they're Southeast Asia, but the scale isn't the same. This is like a whole different league. This is like professional and high school. Like, and looking at Mexico would be, I think, one of the great decisions, of course, but the infrastructure just isn't there. I mean, it would be much more closer. It's in North America. It's right there, a large trade partner of ours, but there would take so much manufacturing and infrastructure just to kind of get it a quarter of where China is right now.
Yeah, I think people kind of underestimate what China has in terms of, I think everybody understands their population is extreme in terms of how it is relative to the rest of the world. And a lot of people have mentioned India in the past about being potential sourcing solutions. But, India doesn't have the infrastructure set up to just plop up a factory. Anywhere. And, it sounds like we finally have Dr. Rogers, but
and I mean, I know we only have a couple minutes left, but would love to hear, if anything, a quick synopsis and
give us a quick one. You got 3 minutes, Zach.
Yeah. What's happening with the LMI?
Give us a quick rundown.
Hey guys, can you hear me?
We can.
All right. This is like the most exclusive club on the internet. It is hard to get in to FreightWaves. All right. So I've been listening to you guys talk on the show as I've been trying to get in, and I agree with a lot of what you're saying. One thing I would throw in, you guys didn't mention it when you were talking about the drugs. It's marijuana 30 days, alcohol 24 hours, cocaine 72 days. And that's experience from my days as a Amazon manager. Essentially what we're seeing this month is warehouse space contracting at a rate that we haven't seen since probably October of 2018. And essentially, that's leading to increases in prices everywhere. And where you're really seeing the crunch is on that downstream retailer side. So as you guys were talking about, we've never had retail be a bigger piece e-commerce be a bigger piece of retail than we're seeing now. I was looking at the estimates. Amazon Prime Day is going to be like $9.9 billion or something. Which is up about 40-something% from last year. And so all of that is taking more capacity, both on the transportation side and on the warehouse side. So transportation, we break down the capacity numbers. Overall, it was a 23, which, remember, any number under 50 means contraction. Closer to 0 means faster rates of contraction. 23 is by far the lowest number we've seen for any metric in the 4 years we've been doing this. And for downstream firms like retailers, it was 16. All right. So for downstream, there is absolutely no trucking capacity. And even I saw a thing this morning, Amazon had planned to sort of act as a freight broker. Okay, we're going to build all this capacity and we're going to let other people use our trucks. They don't even have enough trucks for themselves right now.
Oh, man.
And so everyone is way underbuilt, and it's October. It's October 14th.
Too late.
It's not November 21st.
Well, Zach,
it's October 14th.
Great points. We're going to have you back to cover some of this in more detail next week, but we are out of time. Okay. Thanks again for showing up. 2020 technical issues. It's normal. Yeah. This is what we do.
Well, next time I'll just start off by standing in a field, which is apparently the only place we can connect.
It looks great. It looks great, and we're gonna have a debate topic, so be ready.
Fort Collins, Colorado.
Yeah, it looks wonderful.
We love it.
Thanks again.